Welcome to The Explainer. Today, we're diving into a really strange financial puzzle. What happens when a bank gets hit with a multi-million-dollar fraud, they file a claim, and their own insurance company turns around and accuses them of being the ones committing fraud? So let's start with the number at the very center of this whole mess, $2.3 million. And this isn't just some rounding error on a spreadsheet. This is the kind of money that can spark an all-out corporate war. And yeah, that leads us right to the big question. This isn't just a what-if scenario. It's a real-life showdown where a bank is saying, hey, we were the victim of a huge fraud, but their insurer is pointing the finger right back at them.
Okay, so let's really break this down. In one corner, you've got Missouri Bank, trying to recover from a massive internal fraud. And in the other corner, their insurer, Great American Insurance Company. And they're not just denying the claim, oh no, they're coming out swinging.
Now this is where it gets really interesting, because this slide lays out two completely different versions of reality. Missouri Bank's story is pretty simple. Look, an insider stole from us, we have insurance for exactly this kind of thing, so pay up. But Great American just fires right back, saying, hold on, you misrepresented key facts and you hid important information when you filed that claim. As far as we're concerned, the entire policy is void. It's a classic he said, she said, but with millions and millions of dollars hanging in the balance.
So you're probably wondering, how could an insurance company just say no to a claim this big? Well, it turns out they can't do it on a whim. They need a really powerful legal reason to basically tear up the contract.
And their first legal weapon is something called misrepresentation. In the insurance world, this is a huge deal. It basically means you gave them false information that tricked them into thinking the risk was smaller than it actually was. The insurer here is arguing that the bank just didn't tell them the whole story.
And their second argument is non-disclosure. This is really the other side of the same coin. It's not about the lies you told, it's about the truths you didn't tell. Great American is claiming the bank knew about some essential facts, but chose to keep them hidden, facts that would have changed everything.
So you see what they're doing. The insurer is building their entire case on these two big ideas. Great American is arguing that Missouri Bank is guilty of both misrepresentation and non-disclosure. And if they can prove that, they can argue the whole insurance agreement was breached, which gives them the right to just walk away.
Now, a fight like this never just stays between the two companies. It sends ripples, actually more like shockwaves, across the entire financial industry. Let's take a look at that ripple effect.
For every other bank out there, a case like this is a massive wake-up call. All of a sudden, everyone is scrambling to double-check their own internal controls. I mean, think about it. If a bank gets a reputation for not being totally transparent, its credit rating could take a serious hit. And what does that mean? It means borrowing money gets more expensive, which cuts right into their bottom line. It's a whole chain reaction that starts with just one disputed claim.
But it's not just the banks feeling the heat. Over in the insurance industry, a case like this forces them to completely rethink how they measure risk.
For the insurers, the lesson here is crystal clear. The old way of doing business just isn't cutting it anymore. They're already putting much stricter rules in place, basically putting potential clients under a microscope before they'll agree to cover them. And what does that mean for everyone else? Well, it probably means higher premiums and a lot more hoops to jump through to get this kind of essential business insurance. So we've seen the impact on both sides. What's the biggest lesson here? What does this multi-million-dollar standoff really teach us about the way our financial world works? When it comes right down to it, this entire $2.3 million battle is all about one simple word: disclosure. When that fundamental trust between an institution and its insurer breaks down, it forces everybody to get serious about being clear and honest. Because in the end, it's that transparency that holds up all the confidence we have in the financial system. And that leaves us with one last, really critical question to think about. When transparency fails at this level, it's not just about one bank losing money or one insurer winning a case. It actually chips away at the very trust our entire financial system is built on. So, when the dust settles from a fight like this, who really ends up paying the price?